the big picture is the pricing power of gold is moving east. That's the big picture. I would just bring it back to something that I said in my book, that money gets all the attention, but collateral does all the work. If people would stop obsessing about the dollar and start obsessing about what's behind the dollar.
Gold has rebounded as we get into the third week of June. It comes as markets react to a tentative US-Iran peace agreement and shifting interest rate expectations. But is the real story bigger than gold itself? Well, joining me now is veteran commodities trader Vincent Lanci, whose new book explores why collateral, not money, may be the key to understanding the future financial system. Well, Vince Lanci, thanks very much indeed. It's a pleasure to have you again.
Thanks for having me back, Devin. Good to see you again.
Well, look, lots to talk about, but just off the bat, let's start with this weekend, right? Tentative peace deal in the Middle East. We wake up on June the 15th and goes up more than 3%. Your quick take on what's happening here, Vince?
Well, what we're talking about today, right now, is you had a lot of people that were getting short the market below the 200-day moving average. And with all of the Trump threats for peace, whether you want to call that a taco or not, that as the vernacular goes, this one seems to be catching, and those shorts got caught with their pants down, and gold's up over 3% and silver's up over 4% with more upside in store. Now, do I think the market's going to go back to all-time highs? No, but I do think some people are really getting hurt right now, and I think that's the people that were getting very aggressive, thinking that the gold market is in a bear market now.
Yeah, interesting. Vince, listen, when we spoke in March, you said the big story was structural, right? Not just price action. Since then, gold has, give or take today and a few weeks ago, the price correction or price action did happen hard. Has anything in your big picture thesis changed?
No, nothing fundamentally has changed, which is what you're going to hear when you talk to people. Oh, the fundamentals haven't changed, and they haven't. Central banks are still buying. There's no dissuasion of them buying. In fact, China is buying more on the dip than they were on the highs. So it's not like there's less being bought now. There's more being bought than there was before. It reminds me, if you're looking for a parallel, it reminds me of what happened in 2022. Now, in 2022, when the Ukraine war started, gold made a high close to an all-time high. And what happened right after that is, because of the Ukraine-Russian war, is Jerome Powell started to raise rates to fight inflation. That's when he decided to fight inflation. And when he did that, gold had 5 straight months of down move. And so we're seeing something similar to that now. We haven't raised rates. Warsh is the new Fed chair. He hasn't raised rates yet, but he's certainly threatening to do that. And I think gold is taking that on the chin and as part of the correction. Now, do I think he's going to raise rates? Do I want to speculate on that? Yeah, I'm going to speculate on that. I don't think he will, but that's neither here nor there. So to answer your question, I don't think this downdraft is over. The structural fundamentals are still there. The central banks are still buying. They're buying more than ever. Poland, China, Kazakhstan are buying more than ever. And other than Turkey, which was a seller of gold for a period there, there's been no major selling. So nothing has changed except that we're in a cycle or a seasonality situation, so to speak, where gold is in a downdraft.
Vince, the Middle East has been tense. Oil has moved sharply, and yet gold, if you look at the overall picture, it hasn't behaved like a classic safe haven every day, right? Has the gold trade become too crowded, too technical, or too misunderstood? How do you see it?
That certainly is. It certainly would have been disconcerting to someone who wasn't familiar with it when oil rallied, Middle East tensions increase, and gold sells off. And the reason for that was many countries are getting off of bonds, U.S. bonds, and they're buying gold as a result of that. So several of these countries, will use Turkey, which is the poster child of the situation. Turkey has a large deficit and it had a weak currency. And so when the Middle East crisis hit, it wasn't just a crisis of oil going up in price. It was a crisis of oil supply being cut off from the Strait. And so if your business, as Turkey's business goes, is dependent on the flows of oil, and the flow of oil has stopped, well, then you're short currency. You have bills that you have to pay in dollars. You have expenses you have to pay in dollars. You have debt. You have interest payments you have to pay in dollars. And so they started to sell their gold. Now, it seemed irrational because gold should have gone up during a crisis. But as time went on, it made more and more sense because not only were they selling gold, they were also selling U.S. Treasuries. So they've already bought some gold back, but the Treasuries, they're not buying back. It was an emergency situation, and I think it has been overdone, but we're not out of the woods on that yet.
Look, in March, you told me every dip in gold would likely be bought unless we suddenly got peace breaking out everywhere, right? Are the dips still being bought by the same people, or has the bias somewhat changed, Vince?
There's a two-tiered answer for that. Let me just try and make it one tier. When we talked last time, the buyers were China, Russia, and the BRICS countries that we're familiar with, and Turkey, actually. What's happened now is you still have China buying bigger than ever, by the way. They've been buying for 19 months straight, and their most recent purchase was the biggest in 19 months, the biggest in months. So they haven't bought more than this. They bought more gold at 4,700 than they did at 4,200. Let's put it that way. So they're buying dips from 5,500, but they're buying at a higher clip than they used to buy. Now, the rest of the BRICS, using Turkey as an example, they've backed off. Who hasn't backed off is what we are seeing is instead of that core BRICS contingency that buys, you're now seeing it spread out. You're seeing Poland, you're seeing Kazakhstan, you're seeing Brazil, you're seeing other central banks. You're seeing a broadening of interest going out to central banks. So it seems like you and I are, let's say we're big players in the gold market. Well, when we enter the market, people are going to just watch. And then when we're done, with China as an exception, the smaller guys are coming in to buy now. So it looks like the gold fever is spreading and catching among central bankers. It's on pace for 30% of their total holdings. Poland is now at 30%. So Eastern Europe has been a big buyer of gold recently.
Yeah, certainly the action or the moves by the central banks haven't really changed in the last few months. Let me ask you this. When we last spoke as well, I mean, you said something very interesting about you watching what some of the big banks are doing. And I think you quoted one of the banks where you told me that, look, they're getting the guys to start buying mining stocks now. There's a sort of move towards saying we're going to go mining stocks route. Has that changed or moved in the last few months, you think? What's your take on that?
It has. When we talked about it, we were at the beginning of a mining stock frenzy. Yeah. Mining stocks were starting to outperform. But now they're getting hammered. And so I don't have it's a little bit of a mystery to me, but I think it's the usual culprit. The tech stocks and the AI story are just so hot right now that you're not going to hold on to a mining stock, especially if gold is coming off when SpaceX is going to have an IPO. And that's what's happening right now. So I think those stocks have fallen out of favor because of the other competing narratives that are out there that are actually better narratives.
What happens a few months down the line, when you see the different behavior in gold picking up or doing something else a year from now?
Well, when the price of gold picks up, knock on wood, right? When the price of gold picks up, say November of this year, that's when I expect gold to pick up again. That's when I expect gold to have a serious bid in the market again, because seasonally speaking, that's when people start to buy gold. When the price of gold picks up, I expect the miners to catch up and outperform. And I have bought some smaller underhedged miners to that effect, and I've taken it on the chin. I've taken a hit, but I'm holding on to it because these are 5-year holds, not 5-month holds. And I think I'm probably going to add in the next 3 months as we go into the November cycle.
So, Vince, related to all of that, I want to examine your new book. We'll talk about that in a moment. But first, let's take a look at your Mining Minute. You're watching the Mining Minute on mining.com. I'm Devin Murrigan. A new Global Witness report says coltan from mines controlled by the M23 armed group in the eastern Congo has entered international supply chains. The mineral may have reached products linked to major technology and automotive companies, raising fresh concerns about conflict mineral sourcing. Natural diamonds are seeing a comeback in the United States, led by strong interest from Generation Z consumers. De Beers says younger buyers now account for nearly a quarter of U.S. natural diamonds demand by value, offering hope for Africa's diamond-producing nations. And Canada risks losing ground in critical minerals, energy, and other strategic industries unless infrastructure investment and project approvals speed up. Now, that's coming from a new PwC report that says the country invests less in infrastructure than many global competitors and could require billions in additional annual spending to close the gap. Those are the headlines on the Mining Minute at mining.com. Go to the website for more details. So we're back talking to Vince Lanci, and his new book out, As Good as Gold. Vince, you argued that the global financial system runs less on money and more on collateral. I mean, that's the center point of your book. For viewers hearing about that for the first time, bring them into the loop.
Well, the book is written for people who know something important is changing in the monetary system, but can't explain what. So I should probably start with that. It's not, you don't need a finance degree. I explain repo markets, reserve assets, and collateral chains in plain English. The goal for the audience is to help readers understand the plumbing that sits behind the collateral. Well, the book itself, the short version is the book is, as you said, is that most people think the global financial system runs on money, but my argument is that it actually runs on collateral. Now, when banks need to lend money to each other, actually, let me correct myself. The global financial system runs on trust, but absent trust, you need good collateral, and nobody trusts anyone anymore. So gold has become back in vogue. But when derivatives are cleared, when central banks hold reserves, they're all relying on assets that the system trusts. For the last several decades, 50 years, U.S. Treasury securities have been the dominant form of that collateral. The book traces, there's two halves to the book. It's not a long book. It's an easy book to read. You can read it one afternoon. The first half of the book traces how we got here. We went from a world where gold was the ultimate settlement asset to a world where Treasury bonds became the backbone of global finance. I walk readers through the evolution of that system and explain concepts like repo markets, as I mentioned, dollar recycling, and rehypothecation in a way that non-specialists can understand. But the second half of the book is, I guess, the thesis, if you want to give it a thesis. The second half of the book asks a bigger question. It asks, what happens when confidence in that collateral begins to change, which is what happened in 2022 with the Ukraine war. After events like the freezing of the Russian assets in 2022, a lot of countries started asking whether reserve assets are as politically neutral as they once were, or as they once believed they were. And at the same time, central banks around the world have been buying gold at the fastest pace in decades. So the book explores whether we're moving toward a new monetary architecture, one where treasuries remain important. I don't think treasuries are going to be dumped, but gold and possibly other commodity-backed assets begin to play a larger role alongside them. The term a lot of people have been using is multipolarity, as in more currencies will become more important. And I believe that's true, but it's multipolarity on the collateral side that's going to happen. It won't just be treasuries anymore. It'll be treasuries, it'll be gold, it could be silver, it could be Bitcoin. Ultimately, it's a book about the hidden plumbing of the global financial system and why collateral matters more than people realize.
So the real question then, as I see it, Vince, is no longer whether the dollar, for example, survives, but what assets the world trusts enough to pledge against a debt, right?
That's exactly right. There's the milkshake theory about the dollar, and people like to push back against it and say the dollar is going to be usurped, it's going to be overthrown, it's going to be dethroned or whatever. And people, gold bugs like myself, will say it's gold that's going to do it. That's not what's going to happen. What's going to happen is everyone has dollars. Everyone will continue to have dollars. Everyone will continue to use dollars. But what the dollars have behind them will change. So stable coins lead into that as well. So I have a wallet, and in my wallet are dollars, digital dollars. And in those digital dollars, what are they backed by? Well, I have treasuries. I have a basket of treasuries. I have a basket of gold. and I convert them into dollars to use them. And so the dollar, I mean, I'm not being negative on the dollar. I mean, I can be very negative on the dollar, but just to not be negative here for a moment, you can use anything for currency. Puka shells, I don't care. Woodpecker scalps they used to use in the American South. So it doesn't really matter what the currency is. What matters is what the currency has behind it, as you alluded to, the debt. What is behind the currency? Is it debt, treasuries? Is it an asset like gold? Is it an asset like silver or Bitcoin? Or is it an energy asset like oil? Mm-hmm. What is guaranteeing that currency is what matters, and that's where the collateral comes in.
It's interesting. You spoke about treasuries, right? Now, let's just consider another scenario. If treasuries are still the dominant collateral asset, and you told us how you felt about that in the global system, what would actually have to happen for gold to move higher in that collateral hierarchy?
Well, it is moving higher right now. But to answer that question with a very pointed event, gold was made into a tier 1 capital about a year and a half ago. And that tier 1 capital means any bank that uses it can carry it on its books at value, but they can't sell it. They can't use it for financing. Now, for gold to truly compete with treasuries, it needs to be repoable. Now, I don't know if anyone is familiar with that term. I know you are, but you need to be able to pledge your gold to get financing to build roads. Now, I'll give you a real example for that. What China wants to do, and what other countries that are in their sphere want to do, is they want to use gold as collateral to build their infrastructure out. So as it currently stands, if you're an African country and you want to build a highway, you need to pledge your treasuries for collateral to get a loan to build your infrastructure. What China wants is China wants people to be able to do that with gold. So to answer your question straightforward, gold can't be on a level playing field competing with the treasury market until gold is fully repoable. And the official term for that is something called HQLA. Now, there's a designation in the world. HQLA stands for high quality liquid asset. Now, once the oversight bodies or regulatory agencies see gold as HQLA, and it is HQLA. They just haven't recognized it for fear of competition with treasuries. Once that happens, then it's an equal playing field for treasuries and for gold.
Vince, look, silver, let's just shift focus here. It's sitting, I think it's above 71, 72 at the moment. I can't remember the exact number. But, gold and silver ratio remains close to 70s to 1, right? If silver is as strategically important as physically tight as well, as you've argued, should that ratio be much lower by now?
Yeah, I think it depends on who you talk to, but people who have been around tend to feel that the gold-silver ratio is artificially too high, or in other words, the price of silver is too low relative to gold. And I think what we have seen, to your point, is that the gold-silver ratio was trading 80, 85, 90. Now it's trading 60, 65, a little bit below 70. So I think as you see gold rally, or as you see gold stabilize at higher prices, then silver has the all clear to catch up to it, kind of like the little brother lagging behind. But silver is a high beta play on gold. So if you're long gold and you're long one contract, that's like being long 2 silver contracts. So if gold goes up, silver is going to go up twice as fast. So I do think that's going to happen. As gold becomes global money, silver will become global collateral, which means it's going to not be sold anymore. Russia's central bank is storing it now. It's a reserve asset there. It's a reserve asset in other countries. Now, it's not going to become money, but it will become to a point where you no longer have to sell it. See, this is the problem with the system right now. Yeah. If you and I have gold and we want to raise dollars, we have to do like what Turkey did. We have to sell the gold to get the dollars. But if gold was a repo asset, you wouldn't have to sell the gold. You could just swap it out, and you would basically borrow against the gold. So that's what's going to be coming down the road. When that happens, then you'll see silver enter the party, and then it'll be gold, if gold's trading $10,000, silver could trade $300.
Yeah.
That could happen.
Very,
Now, I'm not
very
predicting that. But as the price of gold gravitates towards a higher level, you're going to see nature step in. So what's the ratio of gold to silver in nature? Is it 15 to 1? Is it 40 to 1? Is it 30 to 1? But that's going to happen. The higher the price of gold goes, the more silver will be compelled to catch up to it.
Yeah. Look, it's interesting you mentioned some numbers there. Let me ask you, as we transitioned from December to January, I mean, you had these forecasts of some pretty ambitious numbers on what the gold price would look like a couple of months down the line, and there were some startling figures put there, right? Do you think that kind of numbers still sit with you, given what's happened over the past few months? What numbers are we looking at a year from now?
Well, it depends on who you're talking to, right?
Yeah.
So right now the banks numbers that they're putting out are mixed and being revised lower. So Goldman Sachs has 5,400 for a target for the end of 2026. They haven't lowered that yet, but their peers are starting to lower. UBS had, I think, 5,200, and I think they went down to 5,000. JP Morgan, I don't think they've lowered their target yet, but they've given the impression that they don't think it's going to go much higher for the rest of the year. Citibank, which is surprisingly still bullish over the next year and a half, has come right out and said it today, as a matter of fact. They said, don't buy this first dip in gold. So Citibank has kind of kicked the can down the road on the price of gold. They still think that gold's going to go up, but they think there's some hard times ahead. But to answer your question, the question implied by your question, do I think those prices are doable? Yes. Do I think they're doable in a short time frame? No. And do I care, which is a little bit of a cheeky thing to say? And the answer is no, I don't, because gold for me is not something that I'm trading. Gold is something that I'm going to be holding on to for years. Yeah. I think $6,000, $8,000, which are still some levels that are out there, put out by a couple banks, are not unrealistic by 2029, 2030.
Yep. Well, look, back in March, I want to just, for a second, go back to silver. You described silver as a just-in-time market with very little slack left in the system. 3 months later, what you've seen is that in the physical market, that confirms that view, or does it challenge it? What do you think?
Oh, it confirms it. It confirms it if you know what went on behind the scenes. Now, to go back to March, the just-in-time aspect of silver meant there wasn't a lot of silver laying around. You had a hard time getting it for the industrials, and the Chinese industrials were complaining about that. They were having a hard time about that. The problem was, in China, there was a fund owned by UBS, and that fund was for investors, and that fund was poorly managed. Not the manager didn't do anything wrong. It's just the rules governing the fund were very poor, and as a result of that, it encouraged speculation. And so you have this physical demand for silver in China when they need it for electrification, and they put a mandate out to do that, to buy more silver, to make more solar panels, to make more electricity. They want to, I don't know if I call it green, but they want to do renewable energy. At the moment they started doing that, it's like an ETF. This ETF starts attracting buyers. And so what ended up happening was the speculators started taking control of the silver that the industry needed. So, which is exactly what we were talking about. The just-in-time nature of silver lent itself to a crisis. Now, China and other countries stepped in and stopped the crisis. China shut the fund down. Yep. China stopped buyers from stepping into other products. China restricted access to buy gold. They use capital controls, which is what they want to do. India stepped in and restricted silver purchases. And so what you did was they tamped down the investor demand, whether it was legitimate investor demand or speculative demand. And in doing that, they restored stability to the silver market, to their credit, if you want to look at it that way. But I don't look at it that way.
Very interesting. Before I let you go, Vince, let me end with this. What is the most compelling thing in the market right now that you're observing that's influencing where your money's going?
Well, from a big picture point of view, the most compelling thing is that the market is truly moving the metals industry to the east. The vaults moved to the east in the 2017, 2020 timeframe. The demand moved east. And today, as we're recording this, JP Morgan and Deutsche Bank just announced that they're going to do a joint venture, and they're going to open a it'll be like London. They'll open a Singapore clearing hub for gold in Asia. So the big picture is the pricing power of gold is moving east. That's the big picture. The current event is, I would just bring it back to something that I said in my book, that money gets all the attention, but collateral does all the work. And so if people would stop obsessing about the dollar and start obsessing about what's behind the dollar and what people are going to use to do financial deals in the future, we'd be in a better situation.
Yep. Well, as I say goodbye, Vince, you want to just bring up your book. I just want to take a look at that title once again.
This is the one that I'm supposed to be sending to you. I was supposed to send it to you, but I had a problem with shipping. But here's the book.
Well, I look forward to reading it. Vince Lanci, it's always a pleasure. I hope to speak to you again. Thanks very much indeed for your time.
Thanks, Devin, for having me. Good to be here.